Ladies, gentlemen, and fellow citizens of the global economy, welcome to today's financial analysis, a session where we'll dive beneath the headlines, go beyond the numbers, and uncover the troubling reality behind Europe's latest inflation saga. Let's call it what it really is, a smokescreen of financial mismanagement and, dare I say, economic malpractice. Once again, we're here to critique not just the policies, but the grandiose promises of policymakers who keep missing the mark. You saw the headline, Euro area inflation ticked upward again, hitting 2.4% in December, up from 2.2% in November. The European Central Bank, ECB, tells us not to worry, that this is all part of the plan, a gradual return to the 2% inflation target. ECB President Christine Lagarde assures us we'll be comfortably back on target by the end of 2025. But do we really believe that? Let's save the blind optimism for those with vested interests. Let me tell you why this latest inflation report is emblematic of a deeper, more troubling story. First, let's unpack the core data. Consumer prices are up 2.4% year-on-year, energy prices have surged for the first time since mid-2024, and services inflation is holding stubbornly at 4%, the same 4% we've been stuck with for more than a year. Rising wages and energy prices are the two culprits ECB officials point their fingers at. And why not? Wages are easier to blame than policy failure, right? But look deeper at this pattern, my friends. The ECB says the rebound in inflation in the services sector is temporary, a byproduct of wage hikes and strong demand. They've been saying this for over a year. Do they think we're not paying attention? As it turns out, wages in the Eurozone did slow down in the third quarter, and yet services inflation remains entrenched at 4%. What does that tell you? It tells us there's more than just wage dynamics pulling the strings here. Let's look at the foundational issues. Core inflation, which strips out volatile components like energy and food, rose to 2.7%, above the ECB's 2% target. That sounds alarm bells for an economy that's grappling with underlying inflationary pressures that are not just temporary blips but potentially rooted in more structural issues, like underlying demand imbalances, supply chain inefficiencies, and persistent fiscal laxity. Constantly telling us inflation will magically disappear on its own by late 2024 or 2025 doesn't instill much confidence, especially when the bank's own data shows inflation expectations among households and businesses rising. Remember that word they love so much, gradual. They'll take their dear sweet time in lowering interest rates, insisting that quarter-point increments are all we need. After a 3% deposit rate with 4 consecutive cuts in 2024, they want us to think they've got it under control. But is this 1 basis point lower reaction, a term so soft it whispers incompetence, really going to be enough? Let's be clear, the ECB's so-called gradual approach is less about prudence and more about them tiptoeing around economic landmines they've helped lay. With inflation in the services sector still stubbornly at 4% and energy prices threatening to spike again, are we really supposed to accept this molasses-like pace of cutting rates? Let's go beyond Europe to put this in perspective. Across the Atlantic, Federal Reserve Chair Jerome Powell has already telegraphed readiness to take more dynamic action if U.S. inflation doesn't taper off quickly enough. Meanwhile, the Bank of Japan remains extremely cautious about inflationary pressures emerging in the global market, which could yank up commodity prices and, in turn, further complicate Europe's energy woes. And here we are, with the ECB dragging its feet with quarter-point adjustments, insisting on an aristocratic approach while betting on stars aligning perfectly to save their economic forecast. Let's not mince words, energy prices are the biggest wild card. After a year of relative calm, with Russian gas flows through Ukraine having nearly ceased, surprise surprise, energy prices are surging again. The December inflation numbers prove that, the first energy price increase since July. Yet, more troubling data emerges when you look closely. European gas reserves have been burning at unprecedented rates, faster than any period in the last 7 years, mainly because of an unusually cold winter. That's real economic pain arriving on the doorstep of households and businesses alike. Faced with deteriorating weather conditions and an increasingly unreliable energy grid, Europe is about to endure renewed energy price spikes. Sure, they've built resilient gas reserves since 2022, but this buffer, as those bureaucrats like to call it, isn't permanent, and it's far from secure. Europe still depends on volatile imports, and as long as geopolitical tensions persist, whether it's reduced Russian supplies or potential disruptions in Middle Eastern energy supply chains, this sword will continue to dangle perilously over our heads. Now on to the elephant in the room. What happens if Donald Trump, back in power, hits the reset button on tariffs and launches a new global trade war? The answer, my friends, is much messier than the technocrats in Brussels want us to believe. Let's break this down with hard facts. Tariffs don't function in a vacuum. They reshape the global economy through every force of insidious disruption. If Trump follows through on his hints of imposing new tariffs, especially targeting Europe's critical industries, the continent is bound to take a significant hit. Imports would grow more expensive, potentially exacerbating inflation as production costs across supply chains ratchet up. On top of that, Klaas Knot, head of the Dutch central bank, recently raised a grim scenario: China, desperate for market stability, might flood Europe with cheaper goods as it searches for new trade partners, exporting its deflationary pressures overseas and throwing the ECB's inflation targets even further off balance. And what does that mean for everyday people? Already, middle-income families across Europe are buckling under the weight of stagnant wages and spiraling living costs. Cheap imports, while seemingly helpful in the short term, could decimate domestic industries and deepen Europe's economic stagnation. Let's not ignore the elephant in the room here: Europe's long-standing structural issues are compounding the inflationary hangover. Too much of Europe's economy remains dependent on government subsidies, overcomplicated by bloated regulations stifling innovation, and precariously perched on half measures toward green energy transitions. The flawed assumption that they can print their way out is only making it worse. And look at how governments have been adding weight on both ends. They create inflationary pressures with stimulus spending and cheap credit, and then fail to deliver the supply-side reforms necessary to improve productivity, innovation, and digital adaptation. Where's the cutting-edge industrial technology? Where's the invigorating entrepreneurial spirit from Europe's middle-market firms? Thank you, failed regulation. What we get instead is this cycle of dependency. Frankly, this feeble-minded policy framework punishes citizens with rising costs while doing absolutely zilch to heal the real wounds festering beneath the economy, an economy that needs complete restructuring before it can ever expect stable growth and low inflation again. And then there's the political paralysis. National governments are still quarreling over fiscal responsibility versus pro-growth stimulus. France and Italy, deeply indebted, call for more spending to stimulate their lackluster economies. Meanwhile, fiscal hawks in Germany are nervous about increasing government debt amidst inflationary risks. What we face is policy deadlock, where no reform packages are moving fast enough, and yet no one is willing to take the tough political steps needed to trim excess spending or implement innovative structural changes across struggling sectors. The ECB's latest inflation bump and cautious rate cuts expose a graver truth: Europe's leadership doesn't know whether to fight inflation by hammering on growth or by pushing for more government intervention. It is a classic case of economic contradictions. Both approaches seem increasingly incompatible with a balanced budget and sustainable growth strategy. Importantly, the Eurozone's fiscal inflexibility is preventing coordinated action, amplifying the problem. And as we debate rising inflation, don't forget the technological elephant stomping through the room: the massive green energy transition. Policymakers' fixation on rapid green transitions, far from the panacea they promise, is likely pushing power prices higher and spurring the very inflation they're being blamed for addressing. Carbon taxes and regulatory burdens for traditional energy sources, while necessary for long-term sustainability, are raising present production costs. These inefficiencies get passed along to consumers, driving the inflationary spiral further. And sure, Germany and France tout their clean energy investments as the future of the industrialized world, but we're kidding ourselves if we don't call out the underlying consequence: these sleek, shining solar plants and hydrogen reactors mean rising costs for everyday citizens in Europe. You can't simply phase out fossil fuels and expect short-term economic stability. You need deliberate and expertly timed transitions, something Brussels has so far spectacularly failed at achieving. So, the next time you hear the ECB bragging about its deliberate, gradual approach to monetary policy, remember that sluggishness and detached optimism don't solve fundamental structural problems. Gradualism, in this context, is clearly a misread of the situation. Inflation's persistence, the renewed risk of energy price shocks, and the specter of fresh global trade tensions leave Europe in an incredibly vulnerable position, one that neither slow rate cuts nor wishful thinking about wages can fix overnight. The path forward is clear but not easy. Europe must overhaul its inefficient labor markets, reform its sluggish public sector, actively foster innovation, and address energy vulnerabilities head-on. And don't believe for a second that waiting until, someday by 2025, is an acceptable solution to persistent inflation and productivity stagnation. In the end, Europe's policymakers must either take bold, decisive action or risk meeting their eventual day of reckoning, a day where the Eurozone faces escalating costs, economic decline, and irreversible political strife. Until then, brace yourselves for more of the same tired narratives, because in Brussels, taking control of the problem seems to be less pressing than simply managing people's expectations with soft words and slow action.